Hello, Fulton. Welcome to our YouTube channel dedicated to tax information. The objective of this video is to provide key information on how to report property depreciation for tax purposes. We would like to emphasize the importance of understanding and complying with tax regulations to avoid legal issues and optimize our taxes. We will start with our first question. How and when should we declare the depreciation of the property in the income report?
Okay, hi Rosie. Thank you for the introduction. In regard to the first question, is depreciation is always what is called a tax shelter and is used whenever there is income produced. So if your property is producing income, meaning you receive rental income, you are entitled to the depreciation. So this depreciation is basically the amortization of the value of the property for your books. It only happens in the books, but it doesn't happen anywhere else because your property actually increases in value here in the USA. So what the Internal Revenue Code is trying to give you or help you is to reduce a piece of the property value or the property price every year. And this is what is called straight line depreciation. Straight line depreciation, you divide the amount of the property, what you purchase for, divided into the number of years of depreciation, that in this case is 27.5. That is the rate for a period. So that number you will use for every year to reduce your expenses. That is entirely deducted from the income. Now, there is also another method of depreciation. If you want to do one-time depreciation, the Internal Revenue Code allows you that when there is a limit of $5 million. There is also another method of depreciation. You can use an accelerated method of depreciation. The IRS really doesn't pay too much attention to the method of depreciation, but once you select it at the beginning of the depreciation period, you cannot change it. Now, it sounds very good, but it's too good to be true, because when you sell the property, you have to recapture that depreciation. It means that all the depreciation that you have deducted from the income, you have to take it back and pay 25% of taxes, unless, of course, that you do not plan to sell the property and you have to give it to your children, or you do what is called a 1031 exchange. That is, you exchange the property for another one, same value, same characteristics of the property, and you don't have to pay taxes there for the exchange. But at any other time, when you sell the property and you're going to get cash, you have to, first of all, pay capital gains, because when you sell the property, you purchase, let's say, 100, and then you're selling at 200. You have a capital gain of 100,000 that is taxable up to 20%. And the depreciation that you took, it's also taxable up to 25%. Those are basically the deadlines, or not the deadlines, the guidelines that you need to follow when you have a depreciation.
Okay, thank you, understood. On to the next question. Is there a different process for house hacking to provide the tax balance?
House hacking first is when you own a property and you are renting the rooms. You are not renting the entire property, but you are renting, the property has 3 rooms and you live in one. You are renting 2 rooms, you receive income for that, and then it's like you share the house with the other tenants, but it's still your house, you live in that. This is what is called house hacking. Now, for the depreciation of the house hacking, it is only the square footage of the rooms that you are renting.
Mhm.
You cannot depreciate the entire house because you are not renting the entire house.
Mm.
It is only the places that are rented or you're renting and you receive income for that. And the concept is the same uh, that we referred before in terms of straight line depreciation. For example, straight line depreciation, as we said in the question number one, is the same. In this case, you have to divide the amount of the house into the square footage. So, for example, if each room is 250 square footage or square feet, uh, that will be 500. And you're renting two rooms, that will be 500 square feet.
Mhm.
And your house is, let's say, that is 1,500 square feet. It means that a third of the property is you can depreciate a third of the property because only a third, 250 square feet plus 250 square feet, that's make up 500 square feet. They
Mhm.
are depreciated only. You are only making income for 500 square feet. Therefore, you can only depreciate for a third of the property because if your property has 1,500 square feet and the two rooms are only 500 square feet, you have one third of the property to depreciate. So the depreciation goes for one third of what is for the entire property. You have to be very careful when you report that. It's a little cumbersome. We help many clients to report this accurate. Remember, the problem with reporting excess depreciation is that when you sell the property, you have to recapture and take 25% of that depreciation, taxes, 25% in taxes of that depreciation. So be careful not reporting the entire amount. I know people say, no, I can report the entire amount. Yeah, you can. There's no problem in that. Your taxes will be lower. You might even create a loss. But when you sell the property, you will need to pay recapture on taxes on the recapture up to
Mhm.
25% on the recapture of the depreciation, meaning that if you depreciate 1 year 100 and then second year 100 more and then third year 100 more and
Mhm.
you sell the property at the end of the fifth year, you will have 500 of depreciation. You will have to pay on those 500 25% of income tax. So
Mhm.
be careful. The best is to be very conservative. Again, I have not seen any audit. We have not any case of an audit when clients report that way or they report depreciation, accelerated depreciation. We don't have any reporting or auditing case that the IRS come to audit the books of the client. With the simple reason that the IRS is going to come back after you when you sell the property, as I explained before. For all this, there is what is called a Form 4562, where that form is the one that when you report the depreciation, the IRS request, and when you are filing your return to report the depreciation, you use this Form 4562. And basically there, you need to report the amount you purchased the property for. If you are doing a full house depreciation, it will be the full house amount. If you are doing a partial partial room or partial house renting, that is called house hacking, you will need to report only the amount that you are renting,
Mhm.
not the full amount of the house. Again, you can report the full amount of the house, and I've seen clients with the not clients, but I've seen comments in in the internet that they say it's okay to report the full amount of the house. Yes, it is okay. The IRS is not going to come after you. But when you get the depreciation back, you sell the house, you have to pay taxes on all the depreciation that you recapture. So be careful about that.
Okay, understood. And what about common areas in the tax report?
And common areas, if they are shared with people or with owners of the property that are not paying rent, I will exclude the common areas because
Hmm,
it's like a park. Um,
makes sense.
You cannot, yeah, you cannot, it's exempt, exactly. You cannot claim depreciation on a common area because it will be like piecemeal. How do I determine the area or the time of the property that I'm using when my tenants are using it?
Mhm.
So I would say excluded is exempt. Just go strict for the rental of the rooms that in case the IRS one day, if you're selected for an audit, the IRS is going to look at your books and it's going to be very easy for you to prove that you are only depreciating those rooms. It's the key here is be conservative. If I am an auditor of the IRS, this is what I'm gonna check. Let's see if this is this house owner or it, he or she is depreciating correctly. Let me see, please, your books. Let me see the amount that you depreciate, how you determine the depreciation. Show me the calculations, and then the IRS will perform their own calculations, the IRS officer, and those calculations will be compared to yours. If they are a match, then fine. If not, they're gonna adjust your books and they will have to pay more taxes. So better
Mm.
be conservative. I know there is many people in different social media and the internet. They say you do this or do that, increase your depreciation, many things, but it's better to be very conservative because the IRS is conservative.
Mm.
So if you play like that, it will be easy for you.
Okay, I understand. And what about if I have a higher income from rentals? Will that increase my taxes?
Yes, because remember, you have more income. It's like you make more money when you rent a property and you increase your rentals, or for the rent of the tenants. It's like you are making more money. Therefore, you're gonna pay more taxes. The key there is I've heard owners of property that they rent and they don't increase the rents year to year, or they don't provide like a steep increase because they want to pay less taxes. So that is fine, providing that it's like you look at the long term.
Mhm.
You look at the long term, and you consider if you want to pay the same amount of taxes for the years, or maybe some variation. That's fine. But if you increase your rentals, or the rent of your properties, um, every 3 years, I've seen commercial rental. I've seen every year, and what's called the escalation rate. In residential rentals, I've seen either contracts year to year, and then the anniversary of the contract that increase the rentals. But again, that's going to impact in your books and also in your taxes. And here, what you have to remember is your what is called your marginal tax rate.
Mhm.
If you have high income and you have more income coming from the rentals, and your marginal tax bracket is 25%, for every single dollar you make, or additional dollar you make, you're going to pay 25 cents of taxes. So you always have to consider that.
Okay, great. Thank you for the thorough and clear information. Now we would like to invite you to summarize some key points and maybe provide additional resources or services related to tax reporting.
Yes, is that remember that for every rental income that you have, the IRS provides you with expenses, deductions. They are not only depreciation, they are also interest from mortgages, taxes, and any other expense that you have for the property maintenance.
Mm.
The amount of the expenses that you have compared to the amount of income, the difference is going to determine the profit of the property, and therefore the taxes that you pay. And any dollar that you have profit from the rental is going to increase your income, and is going to hit your income tax bracket. So you have to be very careful when you are determining the amount of the rent, the amount of the increase of the rentals, the escalation rate, what we call, and how will that impact your tax return. For example, there is the advantage of having real estate. So one of the main advantages is that depreciation many times, especially if the property is very high, depreciation can make what is called a loss. Instead of when you do the summary of the income and expenses at the end of the year, instead of giving you an income or what's called a profit, you'll have a loss. That loss will help you compensate or deduct against your income, rest of the income, like income from salaries or income from interest, up to $25,000. That is a prerogative, or that is a benefit that the IRS has given the any single homeowner, or in this case, any single rental owner, or the owner of the rental property, will receive a deduction up to $25,000 if that deduction is because of a loss from the property operation. So if you have the ability to produce or create income, rental income from the property, it will be a good idea to have your books organized. Meaning, don't wait till the end of the year to do your books. Try to make those, or to do the books, to do the accounting every month, every other month, or at least every quarter, or ultimately every 6 months. But don't wait till the end of the year, because you have no chance to determine the amount of the taxes that you are going to pay for the property administration, for the profit of the property. So better give yourself the benefit of a good accounting system that we can help you with that, and even to the point of going property by property. So you calculate, if you have multiple property, calculate the profits for each property or the loss for each property, and you have an idea before the end of the year how this is going to affect your taxes. And if you have any doubt, any question regarding the property, it will be a good idea to give us shoot us an email. We will be very happy to help you.
Great, amazing. So viewers are invited to leave their information and any comments or questions on this video. Thank you very much, Fulton, for your time and for all the information provided.
It's a pleasure.